Okay, so this part of the discussion is actually to tackle the accounting side of the investments in bonds and of course bonds payable from the point of view of the issuer of the bond. So we'll have the accounting for the issuer and the investor. Okay, so the issuer and the investor, we will be using this example. So we will record and whatever we will have to do, okay, for the next 5 years. Okay, so here the amount that we receive, or the amount that the issuer received from the investor is 9,241,000. Okay, so on January 1, let me put this. January 1, the issuer is the recipient of cash, so therefore he will debit cash, and the cash will be debited for the amount that he received from the investor, that is 9,241,560, and then credit bonds payable. Remember, as far as the issuer is concerned, he has to credit the bonds payable account equivalent to the face amount of the bond, which is 10 million pesos. So there is a difference between the face value of the bond and of course the amount of cash that was received, and this is what we call the discount, because he was able to sell the bonds at a price lower than the principal, and the discount is 758,440. So how do we record that? So we will debit discount on bonds payable, which is 758,440. So if you notice, the discount is reflected as a separate account. From the point of view of the investor, on the other hand, okay, we will record everything as investment in financial asset at amortized cost. That is for the amount of the cost of the bond, which is 9,241,000, okay, 560, and credit cash for the same amount, 9,241,560. So the first difference that you will note is that from the point of view of the issuer, he has to show separately the discount on the bonds payable, but from the point of view of the investor, there is no need to do that. So we will record the investment at the cost. Okay, so on December 31, the issuer of the bond will have to pay the investor the promised interest. Okay, so the interest here is actually the nominal interest, which what we have computed earlier, that's 800,000. So therefore, debit interest expense 800,000 and credit cash 800,000. Okay, so from the point of view of the investor, however, he'll be the one to receive cash. So debit cash for 800,000 and credit interest income for 800,000. Okay, so both investor and the issuer records the interest on the part of the issuer, that's interest expense, and the part of the investor, that's interest income. Now remember that the principal amount of the bond is 10 million, but the amount of cash received is 9,241,000. So there's a difference, which is the discount. The discount now will have to be amortized over the term of the bond using the effective interest method. Okay, so here we will now prepare the amortization table. So the amortization table will account for the effective interest, the nominal interest. The difference between the two is actually your amortization, and then the carrying value of the investment. Okay, now on January 1, okay, the carrying value of the investment is 9,241,560. Okay, now on December 31, which is the first year end, okay, The effective, we will now compute for the nominal. Nominal is 800,000 as what we have computed. And then the effective is actually the effective interest rate multiplied by the carrying value of the investment. So that's 924,156. Okay? So effective is different from nominal. So if you deduct the nominal from the effective, you'll get 124,156. And this represents the bond amortization, the discount amortization. Now remember, in this amortization, the objective is for us to bring the carrying value of the bond equal to the maturity value of the bond, which is 10 million. So therefore, the objective is for us to increase the value of the bond to 10 million pesos. So whatever amortization we have here will be added to the carrying value of the bond. So in this case, that's 9,241,560 plus 124,156. So therefore, the new carrying value of the bond is 9,365,716. Okay? So you just follow the process until you reach the last year. There will be a difference because in the amortization, we did not round off the factor. So we adjust it to the effective interest. Okay, and then you will have 10 million here as your maturity value of the bond. Now, how do we now record this interest or this amortization of the bond discount? Okay, so for the amortization of the bond discount, okay, from the point of view of the issuer of the bond, okay, from the point of view of the issuer of the bond, the discount is a debit balance, so we need to decrease this. And so therefore, we will credit discount. Discount on bonds payable for how much is it? 124,156. So 124,156. And our debit will be interest expense. Note that we are adding interest expense from our nominal because we're going back to the effective interest method. Okay? So this is 124,156. On the part of the investor, we will also record the amortization. Okay, and this time we have to increase the investment in financial assets. So debit investment in financial asset at amortized cost. That is 124,156, and credit your interest income. So in effect, it increases your interest income from the bond investment, no? The amortization of the bond discount. Okay, so if you try to monitor, okay, and prepare the P-account analysis for the discount on bonds payable, first you debited the discount for 758,440. Okay, this one. And then there was a credit to discount of 124,156. So therefore, the discount now has a balance of 124,156 or 634,284. Okay, so if the company prepares its balance sheet as of December 31, 2019, among its non-current liabilities, they will present bonds payable, this is for 1 million pesos, less the bond discount. Okay, discount on bonds payable. Still a deduction of 634,284. So therefore, the remaining balance of our bonds payable is how much? 10 million. Sorry, 10 million. That's 10 million. Okay, so 10 million. So therefore, the remaining balance is 9,365,716. So at December 31, the issuer will show this amount as bonds payable. Okay, which is equal, if you look at the amortization, equal to the carrying value of the bond. Okay, just do the remainder of the years and you will find you will have to amortize the remaining 4 years. Okay, thank you very much.